What's going on, everybody? Welcome to the Life Jacket Podcast, where we talk about topics help you get through the ways of life. My name is AJ.
And I'm Bless.
And as always, before we start our episodes, we always start with the win of the week. So for my win of the week, I signed up for a St. Patty's 5K. I'm looking to run sub 24 time. So it's been real cold. So looking forward to the weather getting warmer and getting back out there and running. How about you?
Beautiful. So my win of the week, my job, we just got some more money so we can add more people onto our program and don't have to lay anyone off. So definitely it's good that, our budget's starting to get expanded rather than decreasing.
Great. And so for today, we have a guest, Dante Lloyd. He is a certified financial planner who helps physicians, executives, attorneys, and business owners build powerful strategic financial plans that actually align with their lives and long-term goals. With a background in leadership from the University of Delaware and license across investments and insurance, Dante brings both technical expertise and real-world perspective to his client relationships. He is also deeply committed to mentorship and financial education for the next generation of professionals. So for this episode, let's get ready for a dynamic conversation on building wealth with intention. Dante is also my frat brother and also my financial advisor and one of my really good friends. So hope it's the pod. Dante?
Appreciate it.
Before we get started, what is your win of the week?
So I guess 2 wins wrapped in one. I paid off my student loan
That's tough.
and my car loan, both this past week.
That's nice.
That's kind of tough. Can't lie. That's a great win.
Beautiful. All right. So what kind of got you into like the financial world?
High school, I think I just took a liking to accounting.
Okay.
And that was one of the courses that I did the best in when I was in high school. So transitioning to University of Delaware, I thought I was going to be an accountant.
Yeah.
Just because literally in high school, that was the only class that I not only excelled in, but also enjoyed.
Mm-hmm.
And then accountant didn't work out in college. It was a whole nother level. And I said, you know what, I still want to deal in the finance world, but I want to pivot to something different. So my academic advisor actually went through a list of different majors that I could qualify for based off of like the credits that I had already accumulated.
Yeah.
Organizational and community leadership is the one that I landed with. And I said, so what can I do with that major?
Yeah.
And he gave me a whole list of things, but financial planning and financial advising was the one that stuck out the most. So I figured it'd give me the best of both worlds of not only dealing with finance, but also having a more like social side and human side as opposed to just crunching numbers.
Yeah. I think even in today's educational system, financial literacy still really isn't part of like the educational system in regards to like credits, debts, like using your money and stuff like that. So I'm glad we have you on the show so that way you can let our audience kind of get some information on, what they should do with their money or how they can make their money work for themselves. So I do have a couple questions for you. So what is the very first financial move someone should make if they feel completely overwhelmed by money?
Well, I think the first thing you should do is get organized, right? You can't improve what you haven't measured, right? So you want to take a measure of where you're currently at, figure out what you have in savings, what you have in debt, what your interest rates are on all those debts. And you also want to look at what your regular reoccurring monthly expenses and monthly spending habits are. And I think once you start with accumulating that data and figuring out exactly where you are, you can start taking some intentional steps to move forward.
Okay.
Depending on where you're at, that could mean different things for different people. So if you're just getting started out, it could be paying off high interest rate debt. It could be building an emergency fund. It could be getting started with some type of small reoccurring investment, or it could just be figuring out like what expenses are unnecessary in your life that you can cut back to increase your cash flow. So it really depends on the person. But the first thing I would say to anybody, regardless of where you're at, is you want to get organized and figure out exactly what you're working with, income, expenses, debt, and assets.
Great. I guess my next question is, what's a simple budgeting method that someone can use for someone that just hates budgeting or doesn't prioritize budgeting at all with their finances?
That's a good question. I am a big fan of once you are organized and know what your regular reoccurring spend is per month, and you know what your regular reoccurring income is per month, except for, maybe business owners where it varies. Instead of trying to track every single expense every single month and then budget from there, I would just pay yourself first, right? And what I mean by that is set up some type of reoccurring deposit to a savings account or deposit to an investment account or both. So that way you can spend whatever's left over without a guilty conscience of, oh man, I didn't leave enough money left over to save, right? So I'm a big fan of making savings and investing one of my reoccurring bills so that I treat it the same way I treat my rent, right? I got to pay it. So
yeah, I think one thing one of my friends does, he's so bad with his money and so bad at budgeting. When he gets his annual check, he has 25% of it go to another account. He then took the debit card to that account and shredded it so we can't get access to it. I'm not saying go that extreme, but a lot of people really do struggle with budgeting and saving money.
Yeah. That's a little bit extreme.
Yeah, it is extreme. It really is.
I think that I like that idea of 25% or whatever the percentage is based off of what you can comfortably do. There's two ways that I do it. One of them is most companies offer direct deposit where you can not only have money go directly to, say, your checking account, but you can have a portion of it go to a separate savings account automatically. So it automatically, that money already is going there without you having to worry about segmenting it, right? So that's already doing part of the job. Obviously, a lot of companies offer retirement plans like 401k and 403b that forces you to put a part of your check in there automatically before you receive it in your bank account to spend it. Yeah. And then the other way you can set it up is I have several savings accounts. So when I get my check into my deposit it to my checking account, the very next day I have an automatic transfer come out of my checking and go to several different accounts that are all purpose for different reasons.
Yeah. What do you think is the number one financial mistake?
I would say the number one financial mistake, in my opinion, is having your lifestyle inflate along with your income, right? So you get a raise and all of a sudden you're spending more money right away, right? I say this to a lot of the clients that I work with. We're going to, as humans, we take up the space that we're given. Right. So whether we're talking about money or anything arbitrary, your teacher gives you an assignment and it's due in a month. Most of us start working on it the day before. Right. Yeah. If you get a paycheck that's $100 and you have to make it last for a week, you'll find a way to make it last for a week. But if you get a paycheck that's $1,000 or $10,000, for some reason, we always find a way to spend a larger and larger portion of that. So I typically am going to suggest that if you have some type of increase in income, whether it's a raise or a second source of income that kicks in, try to find a way to start saving more of it right away so that it's already built into your habits and maintain the current lifestyle you already have. Yeah. Or if you do need to increase it, just make sure you're not taking up all of the raise or all of the additional income and putting it all towards your nicer car or your nicer place or your newer vacation or your more frequent vacations and things of that nature.
What do you think is the fastest way to rebuild credit after making financial mistakes?
So the first thing I would say is understanding what it takes to build your credit score in general. There are several categories that help build your credit score, and understanding what each of those are is the first key. The two areas that impact your credit score the most are, number one, making payments on time. And that takes up about a third of your credit score. So if you miss one payment and you're late, which companies can't report you late until you're late more than 30 days. Granted, you don't want to be late 10 days because they're probably going to charge you an extra fee, but 30 days is when they can report you to the credit bureaus. So once you're late, you will, in most cases, automatically drop down from what's considered excellent to good. And then the next time you're late, you might go down to average and below average, et cetera. That makes up a third of your credit score. I think it's 35% to be exact. So making late payments kills your credit. Be on time. The second thing is going to be your utilization. So Utilization is essentially what percentage of all of your credit card limits are you taking up. So if I have one credit card and my limit is $1,000 and I spend $500 on that credit card, I'm using up 50% of that limit, right? Ideally, you want to be good, you need to be under 30%. And to be excellent, you need to be under 10%. So understanding those metrics, I think is going to be important. There are other things that make up your credit score in terms of just how much total access to credit you have. I think in order to be excellent in that category, it needs to be above 50,000. How many inquiries you've made in recent years. You want to stay on average one or less per year. Obviously, it's not totally unavoidable. If you need to go out and buy a new house or finance a car or whatever, you need to have your credit checked most times. But what else? Those are a few that I can think of off the top of my head. The two biggest ones are utilization and making payments on time. So try to stay under 10% to be excellent out of your utilization, and make all your payments on time.
Okay.
If you can, automate it.
What do you think about, I guess, life insurance?
In what aspect? What do you mean?
Should somebody at the age of like 20 or 30 end up buying life insurance as like an asset or something?
It depends, because you could use life insurance for a bunch of different things. I got my first insurance policy when I was 23 or 24. And I've continued to build upon those, and I'm 36 now. I have several policies. I think that it's really important part of your overall financial plan. In terms of using it as an asset, there are several different types of life insurance. There are some that are not necessarily an asset. You're just purchasing it as a death benefit for your family in the event you pass away. And there are others that you can use to accumulate as not only a death benefit for your family, but also an asset on your balance sheet. I'm a little bit biased because I sell the stuff. So, but I do think that everybody should have some form of life insurance. Whether that's going to be term or permanent is going to depend on your personal situation. I work with a lot of clients in that space, from, people that are entering into retirement to people that are middle age and married to people that are, younger and single with no children, like me. And I think that there's a use for it in all of those stages of life. It's just a matter of what's going to be most important for your family.
So if you could break down life insurance to someone in less than 60 seconds, what would you say?
The most important thing is making sure that there's a death benefit in place when you die, right? So the next thing is making sure that it's the right amount, right? There's several different ways to get to the right amount for different people. So there's no one right or wrong way to get there, because different advisors have different theories on that. But I've never, delivered a death claim and had a family say, this is too much money, right? The third most important thing is going to be making sure you have the payout structured correctly. So you can have it paid directly to an individual or a charity or a company, or you can have it paid to a trust. I'm a big advocate of using trust for life insurance transfers. And then finally, you want to make sure you have the right type, right? Again, that's going to depend on everybody's unique scenario. I think in terms of the mechanics of life insurance, in a quick blurb, you have term coverage, which is temporary. Usually will cover you for anywhere from 10 to 30 years. If you pass away during the time frame that you selected, it'll pay out a benefit. If you cancel the policy or outlive the policy, it doesn't pay out a benefit, right? So some people don't like that part. The nice thing about term insurance is, relative to the alternatives, it's inexpensive, right? Somebody who's in their 20s and really healthy and doesn't smoke, best case scenario can probably get over $1 million of coverage for $50 to $100 a month, right? If not less in some cases, depending on what company they go through. Permanent insurance typically is designed not to expire. Some of them also build equity, which in the insurance world, they call it cash value. And that can be used for several different reasons, whether it be, there's no insurance companies typically don't ask you what you're taking your cash value back out of the policy for, right?
Right.
They just say you want it, you can borrow it, or you can take a cash surrender, or a dividend surrender, depending on the company. So it provides some extra liquidity. And the nice thing is that it can be done if set up properly in a tax-free way.
I have a question. So if I'm someone hypothetically looking for life insurance and I'm looking at different companies and maybe I go to an affair and there's different agents I'm talking to that want to sign me up on their life insurance, like how should someone differentiate buying life insurance from a certain company and maybe a certain advisor? Like what advice would you give them?
That's a good question. I would say the company, and again, I'm biased on this, so take this with a grain of salt, but the company is going to, you want to choose a company based off of what you want. There's certain companies that cater towards certain types of life insurance, whether it's term or some type of permanent, right? There maybe 5 very, very common types of life insurance that exist out there. And some companies offer some of those options and others don't. So depending on what life insurance is going to make sense for you, you want to pick the company that's going to offer those products. The second thing is specifically if you want a policy that's going to be permanent, and build cash value, I'm a big fan of companies that will pay the insurance policyholder a dividend. There's a small group of companies that exist that do that, because then those dividends will benefit you as the policyholder as opposed to stockholders. If you're just looking for term insurance, a lot of times you want to go for a company that's going to be less expensive. Less expensive doesn't always necessarily mean greater value, but in the term insurance space, that's generally going to be the bottom line. There are some additional features that you should take into consideration, but the list might be too long for this conversation today. And then I would say the last thing on company is going to be financial strength, right? Just like you and I get a credit score that talks to lenders about how worthy we are of borrowing money and the likelihood of us paying it back on time, right? Insurance companies get a credit score as well. It's called a credit rating. And there's several companies that rate insurance companies, A&M's Best, Fitch, Moody's, and there's also a Comdex score, which is like a compilation of all of them. You ideally want to go for a company that has a higher rating, right? Because that means that they are better suited financially to make sure that they can pay their claims in the event of a major catastrophic event. So that would be how I go about deciding what company to use. For me, when we take clients in, I am typically asking them a lot of questions about what their goals, priorities, values are, and what they already have in their financial tool belt, if you will. And then once we determine what kind of insurance makes sense for them, we'll pair them with a company that's going to be best fitted for them, because I'm appointed through, I have access to about 40 different insurance companies. So it's not just one or the other. In terms of how to go about choosing an agent, I would say I would personally avoid somebody who is pitching you a certain product without knowing anything about your overall financial makeup, right? Without knowing anything about what your goals and priorities are. If they come in saying, hey, you should buy whole life insurance or you should buy term insurance and this is the reason why, without knowing anything about you, that's probably somebody you want to avoid, because they likely have an agenda, right? As opposed to someone who's asking you questions, getting to know what your family makeup is, what kind of coverage you already have in place, what your goals are, and then mapping out an insurance program that meets those needs.
Gotcha. I know we talked a little bit earlier pre-podcast about divorcing and divorces and stuff. And I read, I'm not sure how true it is, but most divorces pretty much happen because of like a financial hardship or something in regards to finances. So how can couples or families talk about money without it pretty much turning into a conflict?
That's a good question. I think making it a habit, first of all, I think, especially me, I grew up in a time frame where talking about money and with family was kind of like taboo. And I've gotten a lot more comfortable with it now because of the role that I play for my career.
Mhm.
But a lot of families aren't in that space, right? It's still taboo for them. So I think making it a common conversation is one thing. The next thing is maybe spend less time talking about specific spending items and more time focusing on collaborative goals, right? You know, me and my significant other want to buy X, Y, and Z. How are we going to get there? And let's focus on that as the goal, as opposed to, you know, why did you buy those pair of Jordans?
Yeah.
Why did you spend money on that PlayStation when you know we have X, Y, and Z? So, yeah, focus on the goals as opposed to the day-to-day spending. Now, obviously, if you're being irresponsible in one way or another, then you need to check that. But making it a frequent conversation and focusing on the goals as opposed to the daily spending is our two big things. I would say the last thing, again, I'm gonna throw this out there. I'm biased because I do this for a living, but hiring a financial planner to outsource those conversations to a third party and make me the bad guy, right? If I say you gotta stop doing that if you're trying to get here, right? You could put that on me as opposed to putting that on your husband or on your wife, right? And so I facilitate a lot of those conversations, and you know, a lot of times when I sit down with especially a couple for the first time, and I ask them about their goals, the goals that they share frequently are not things that they've talked about to each other. So sometimes that comes out in that meeting, and it's just because I'm asking them questions that maybe they didn't think to ask in the past, right? You don't know what you don't know. So hiring some type of third party counsel is a good way to make that conversation healthy and productive as well.
Yeah, I think one thing, you know, I've noticed, especially like in the Black community, especially when it comes to funerals, death, is when people have assets and money's left over, you see a lot of arguments. People stop talking to each other. I've seen like brothers and sisters not talk to each other for years when it comes to like assets and what happens when the family member dies. So how do you go about having those conversations with family when it comes to, well, hey, like I've got these assets, but if something happens to me, where do they go to? Maybe like having those conversations before like the family member dies, and then it's just chaos once they're gone, and people are hiring lawyers, trying to sue each other, and things just get really, really crazy.
Yeah. How am I going about it with the people that have the assets or the people that are receiving them?
Both.
All right. So with the people that have the assets, right, you know, maybe it's an older couple or older person, and they're trying to do, you know, figure out who gets what. Is a couple things. It depends on what the assets are, right? Because assets come in different forms. It could be insurance. It could be money in the bank and investments. It could be assets in the form of properties or businesses, right? So that's when it gets tricky, because you might have, let's say, 2 kids, and you know, maybe you own a business that's worth a lot of money, and one of those kids has that big business acumen and the other doesn't, right? So that's a conversation to be had in terms of, do I want the child that I have that doesn't have the business acumen to be, you know, the beneficiary of my company, right? Because they might drive it into the ground or sell it, and now all of my employees are unemployed. If it's, you know, maybe not a business conversation, but just, you know, I have assets in the form of houses, cash, investments, life insurance, then it's, you know, do I want people to get it 50-50? And if so, do I have the right beneficiary set up to make that happen? Or do I have a trust set up to make that happen? So without getting like too deep into it, my grandfather passed away in 2007, and he had an investment account that we found out years later. We didn't find out, or at least I didn't find out, that he had this until I got into the finance business, which was 2013.
Oh, wow.
So my grandmother approached me about it, and you know, we ended up contacting a lawyer because he didn't have beneficiaries assigned to that account, right? So now it's like, okay, well, who's his money go to? And long story short, we had to go through the court system, go through probate, spend a couple $1,000s on the lawyer fees. And then because there was no will and no beneficiaries assigned to that account before he passed away, the state of Pennsylvania decided what happened with the money, right?
Oh,
So
wow.
they said 50% of it goes to my grandmother, his wife, and the other 50% was split between my grandmother and their 3 children, my mom and my 2 uncles. Right? Depending on what state you live in, it might turn out different. And what I often talk to about people is if you don't have a plan, the government has a plan for you, and it may not be what you want, right? So start having those conversations with your advisor, your estate planning attorney early, so that you can make sure you have all your ducks in a row whenever you pass away. Because it's one of the things is guaranteed, we're all going to die someday.
Yeah.
So I would say the other thing is that I'll use an example of a case I was working on. There was a client that was referred to me, or not a client, we didn't take them on, but there was someone that was referred to me. He had a grandmother that passed away that ended up leaving him a little bit over $1 million. Grandmother passed away in January. I was referred to him in September of whatever year that was. By the time I met him, he was in his 20s, by the way. There was only $250,000 left.
Wow.
He spent over $750,000 on just stuff, random stuff, right? And so I talk a lot of times about implementing some type of trust, especially if you have beneficiaries that are younger in age or that may not be very finance savvy, because studies show that a large percentage of people that receive inheritances or lump sums of money or lottery or, even athletes, right? They go broke a few years after they finish their career because they weren't taught to harness that money and make it last long. And when you implement things like a trust, you can control the money from the grave, so to speak. You can assign instructions of, okay, this person is getting this money, but they're not getting it all at once. They're going to get X amount right up front, and the rest will be paid out over the next 5 years, 10 years, 20 years, right? So that it lasts for a longer period of time. And you said, what about the people receiving it?
Yes.
See, that's a trickier conversation.
It's okay. We could save it for another.
All right, we'll save that for another, because
Your answers are very like in depth and good, so that's why I know.
Okay.
You would give me a very in depth, which is great, but I do think we could probably save it for another
part 2.
episode. Yeah, part 2. Yeah, for sure.
All right. So what separates people who builds wealth from people who just earns money?
Ooh, separate people that build wealth to people that earn money. Well, it's about it's not always about what you make, it's about what you keep, right? So you can make $1 million a year, but if you spend, 950,000 of it, you still be broke at the end of the year, right? I've met really high income earners that struggle to put their kids through school, and I met people that make very, modest incomes that put multiple kids through school. And again, a lot of it is about not what you make, but what you keep. So what separates the two, I think, is disciplines and habits with your relationship with money and putting money away and aside for your future self. And not just, I'm making more, so I'm spending more and, upgrading my lifestyle every time that I get some type of influx of cash.
Gotcha.
That's a big differentiator.
Yeah.
If someone is trying to invest, but they're living paycheck to paycheck, and they're trying to be very minute about where their money's going, what would you advise them to do?
The first thing, if they don't already have an emergency fund, is build an emergency fund. Ideally, you want that to accumulate to be, 3 to 6 months of whatever your regular monthly expenses are. But I would say at bare minimum, you need to have $1,000 set aside, so that if you have an unexpected emergency, right, your car breaks down, your cat gets sick, right, you're not putting yourself in debt to take care of that emergency, right? So start with that. Once you accomplish building an emergency fund, by means of what we talked about earlier, right? Taking a small portion of your check and putting it aside automatically each month. Then start to transition that money that you were using to build your emergency fund to then start to build up a small investment portfolio. You don't need to go from doing nothing to trying to put away thousands of dollars a month, right?
Mhm.
Even if you're starting to invest 25 or 50 bucks a month, it's probably not going to make you rich, but the habit will make you rich, right? So it's all about building disciplines and habits and then building upon them once they become
Mhm.
a regular occurrence. A lot of people that approach me for wealth management services think that they have to be rich to start investing, and that's not the case, right? You just need to start somewhere.
Yep.
And again, I think that the habit and discipline of doing that on a regular basis is the big key there.
What is advice you would give for someone who wants to be a financial advisor and is just starting up? Like I know you personally, so I saw how hard you grinded to get to where you are, cold calling people, going to the contests, etc. I'm sure there's a lot of financial advisors, but I'm sure people quit along the way or they're not able to excel their career maybe as far as you have. So what advice would you give them?
Yeah, for folks that are just getting in the career or trying to get in the career.
Just getting into the career.
Oh, yeah. So they'll probably get this from whatever firm they start with, if they start with a firm, but you don't want to leave any stones unturned, right? When I got into the career, I think I called almost everybody I had in my phone book on my phone.
Yeah.
Even folks that I hadn't talked to for several years. And I didn't call them to sell them right away. A lot of times it was just rebuilding a relationship,
Mhm.
asking them out for a coffee or for lunch or, just to set up a phone call to talk to them about what I did. And see if either they had some interest in talking about it further, if they had any advice for me, because maybe oftentimes they were older than me. And they were able to give me some career advice because of their experience with other people that worked in my profession. And sometimes they have referrals for me,
Mhm.
right? So that was key, right? Don't be scared to call your friends and family, and most firms will force you to do that anyway. That's part of like your break the ice ritual in the
Mhm.
beginning. It's a rites of passage. You have to do that. Cold calling is very difficult. I was never a fan of cold calling. I think I've made one cold call in the last 13 years. I did reach out to a lot of people on LinkedIn because you can find exactly the type of professional you're looking for if you're trying to target a certain market, and be very intentional about that. So use those tools. And then once you get rolling, you want to eventually find a niche market, right? A target market. When I started, I was working with anybody, and I started at 23. So other 23-year-olds weren't really the ideal client for me because they weren't making a ton of money. So that meant that I wasn't able to make a ton of money if they did become clients. But eventually I started focusing on working with doctors, right? Because number one, they're higher income earners. So that meant that my business could potentially revenue more if we brought them on as clients. Number two, there's a big need in that market, right? They go through a bunch of schooling on learning medicine and how to treat people, and they don't get any financial literacy or very, very little throughout that program. And number three, they at least not identical, but they have a lot of similar personality traits. And it makes my job easier because I can focus on knowing everything I need to know about finance and everything I need to know about that one career type, as opposed to needing to know everything about finance, that career, and then 50 or 100 other career types, right? A lot of doctors have the same exact track, and it's a very duplicatable process. So call friends and family, start to get referred out, be very persistent, right? It's a lot of times bringing in a client or getting a sale, and it doesn't happen on the first ask. It happens on a second, third, fourth, fifth ask, right? I had people that I reached out to and I stayed in touch with, and they became clients 3 or 4 years later, right? And Also, you don't always have to shoot for like the biggest fish out there. Sometimes you want to aim for people that have a lot of potential. Some of my biggest clients today were some of my smallest clients, like in the very beginning, and they just had a lot of growth in front of them, and I knew that. So I try to, do what was right for them.
Yeah, and I think for me, I'm not a financial advisor, but advice I would give is just really just knowing your stuff, coming on very professional. So for me, my grandmother left me a policy. Well, has a policy now. She's still alive. She made it when I was 8 months old, and she didn't even know what she was doing. She told me somebody advised her to do it. She signed some stuff off and just made payments every month. But now that I'm older, I see the benefits of it. So I remember I went to the advisor who wrote the policy, and I was talking to him, and like he would kind of brush me off, wasn't very detailed. He was older, so he probably just had enough. He probably didn't really care, honestly. So I was like, she kept asking me to talk to him. I was like, I don't think he has my best interest, but I know Dante does this. And so we had some conversations, and then I think maybe after a second conversation, I was like, well, I want to do a whole life policy. Let me just sign one under you so I have my own under me, and my mom's a beneficiary. So, and I saw you at events, saw your professionalism, saw the work you were doing, and I feel comfortable if somebody is looking for an advisor, I can refer you because I know like you'll take care of them. So I think just the way how you carry yourself is really important as well.
Yeah. I think on that note, actually, there's another tip I would give. And that's I think when you are in an industry that is, it's a predominantly white male dominated field, right? So me coming in as a minority, a lot of people look at that as something that could hold them back, right? And in some cases it is. I don't want to invalidate that thought, but for me, it's been an advantage in my perspective, because a lot of people in minority communities don't have ready access to a financial advisor that looks like them, that they can trust. And a lot of us aren't getting that financial literacy because of that. And we're also not being targeted by people that don't look like us. Right. So, I've used that. Like, I work with a lot of physicians. I go and speak at conferences for Black physicians, specifically because I know that they need this information, and there's not many other people that are going to be there to support them, their goals, and, their financial goals. So that's been a big benefit for my business, because it's a big pool of people that, I'm able to help. So that's one thing. I would say the other thing is, I was going to say on that note, because of that, when you first start out, you kind of have this feeling of needing to code switch, right? And I feel like I did that a lot in my first 1, 2, 3 years of business. And eventually I made a conscious decision to just be more authentic, right? And just be myself when I was in meetings. And not that I wasn't being myself, but I was definitely turning it up a little bit. Not to say you don't want to be professional, right? But the more you could be yourself, and the more you could let your personality show through, the more successful you'll be, the more happy you'll be, because the clients that you attract will be people that you actually vibe with, right? Cool. And so I would make sure that, I wish I had done that sooner.
Okay.
And lastly, make sure you have a mentor. That helped a lot too. Having people that could have already gone through this process that I can like kind of latch on to and piggyback on.
Perfect. So I think you pretty much explained a lot of good information in regards to, I guess we can relate it to like the life jacket, like the financial life jacket. What's some like advice, a quick advice that you would give to our viewers and listeners in regards to having a life jacket, that financial life jacket, so that way they don't sink?
That's a great question. A lot of things that we talked about, I feel like are, the basics of building that life jacket, right? Understanding where you're at, building some type of emergency fund, getting out of high interest rate debt, because that can be something that's anchoring you down as opposed to letting you float. Analogy king. And then having somebody that you can rely on for solid financial advice, I think is key, that you can run ideas or thoughts by and get advice on your situation, that have either gone through that themselves or someone like me who has just worked with thousands of people at this point who have gone through a bunch of different scenarios, and I can tell you right off the bat, like, hey, this is what you should do based off of your scenario, and this is the reason why. And whether that's somebody that you're hiring or just a friend or family that you know is financially successful. I would say you want to be around people who you would like to emulate in one way or another, right? Because a lot of times your what do they say? Your net worth is your network. So being around people that are at your level or above, right, will oftentimes help you rise the tide.
Absolutely.
I think that's all the one-liners I got for you.
Where can our viewers find you at, or where can they reach out to you if they're interested in signing up for life insurance or have any financial advice?
So you can reach me. Best platform is on LinkedIn. Donte Lloyd, DonteLloyd. Reach me on LinkedIn.
Okay.
Connect with me there. If you don't have LinkedIn, get LinkedIn. I'm not a sponsored ad. They don't pay me for that, but it's a great networking source. So that's the best way to reach me.
And I can speak on behalf of Donte. He's my financial advisor. He's great. He's helped me out a lot. My life insurance plan is phenomenal. I don't even know it's a direct deposit anymore. So, yep, I recommend him for anybody who's looking for someone for life insurance or financial advice. So,
appreciate it.
All right. So that's it. Any final words? Are we good?
We're good to go.
Cool. All right. Until next time. Peace. Appreciate you.
The simultaneous peace sign was hilarious.